Home prices in some California markets are continuing to create challenges not seen in decades. It has some homeowners looking to evaluate their options, worried that things may not improve soon. The California Association of Realtors says the median price for a home in 2024 was about $868,000, which represents a dramatic shift in affordability compared to previous years. California's housing agency said the challenging market conditions were reminiscent of previous housing crises. For years, California's skyline was a symbol of endless growth. Construction cranes carving new developments into horizon, buyers treating homes like investments that always paid off. But in 2025, that confidence is shifting. Home prices in California have stagnated in many areas, while affordability has plummeted. Entire communities that once saw rapid appreciation now sit with homes lingering on the market, their pristine facades reflecting a market that's lost its momentum. Developers are reassessing projects, shelving plans before they even break ground. The government scrambles to address the crisis. Yet, every policy shift seems to complicate things further. For a state once hailed as a nation's dream destination, the slide feels surreal. Buyers are trapped between unaffordable prices and mounting debt, while builders face a landscape they no longer recognize. Behind the headlines lies a deeper unraveling, one that could reshape the future of housing in the Golden State. What caused California's unstoppable housing machine to suddenly seize up, and how far will the fallout spread before stability returns? But before we dive deeper, if you're finding this valuable, hit that subscribe button and drop a comment below telling us which California city you're watching most closely. Your engagement helps us bring you more content like this. The numbers that tell the story. California's housing market was once the definition of the American dream. Every purchase felt like a smart investment. Every buyer walked in believing they couldn't lose, and every seller seemed to hit the jackpot. For decades, that belief drove confidence across the entire state. People saved for years to make down payments. Banks evaluated financing carefully, but demand felt endless. But in 2025, the shine has faded. What once looked unstoppable now feels insurmountable. The numbers tell a story that few want to face. In 2024, the median home price in California reached $868,000, making it the most expensive housing market in the nation. Mid-tier homes in California are now more than twice as expensive as the typical mid-tier home in the rest of the United States. A price point that once seemed aspirational has now become a barrier for millions. By the second quarter of 2025, the situation had only intensified. The median-priced home climbed to over $900,000. To qualify for a mortgage on this median-priced home, a California household needs an annual income of about $237,000. That's more than twice the median California household income of $96,500. The dream of homeownership has dissolved into anxiety and impossibility for the vast majority of residents. The California Association of Realtors data paints an even harsher picture. Only 15% of California households could afford to purchase a home in the second quarter of 2025. Compare that to 34% nationwide. In 2022, those figures were 16% for California and 38% nationally. While affordability is shrinking everywhere, California remains far less accessible than the rest of the nation. What stands out most isn't only the high prices, but how they persistently stayed elevated. California has never seen this level of sustained unaffordability. For decades, the state sold the promise of prosperity and opportunity, an idea that homes were the ultimate wealth builder. Now that promise feels broken, and the question hanging in the air is when, if ever, relief will come. The down payment dilemma. The barriers to entry are staggering. To purchase that median-priced California home at $905,000, a household needs about $181,000 in cash for the standard 20% down payment. Nationally, the required down payment is roughly $86,000. That's more than double. For first-time buyers, this creates an insurmountable obstacle. Even those who have saved diligently for years find themselves falling further behind as prices appreciate faster than they can accumulate savings. It's a treadmill that keeps speeding up, and fewer people can stay on it. Monthly payments for a newly purchased mid-tier home in California were over $5,900 in June 2025. That's an 82% increase since January 2020. For a bottom-tier home, monthly payments exceeded $3,600, representing an 87% increase over the same period. These aren't modest adjustments. They represent fundamental shifts in what homeownership costs. The gap between monthly costs of purchasing a bottom-tier home versus renting has reached levels not seen since the housing bubble of the mid-2000s. Renting, while expensive, remains significantly cheaper than buying. Monthly rents have grown substantially, but not as quickly as monthly payments needed to purchase a home. Monthly payments for a two-bedroom home are about $2,010, or 72% more than renting an apartment or home of similar size. The wage gap. Since January 2020, California housing costs have grown far more than California wages. From January 2020 to June 2025, the growth in monthly payments for a mid-tier home, 82%, and bottom-tier home, 87%, have far exceeded growth in average hourly wages, just 23%. For working families, this means housing costs are consuming an ever larger share of their income. What was once affordable on a middle-class salary now requires dual six-figure incomes. Teachers, nurses, police officers, and other essential workers find themselves priced out communities they serve. The California Legislative Analyst's Office notes that areas with the fastest growing cost of homeownership are focused in Southern California, though the crisis extends statewide. Even traditionally more affordable inland areas like Sacramento and the Inland Empire have seen dramatic price increases, though they remain below coastal levels. Regional variations. The crisis isn't uniform across California. The Bay Area remains one of the most expensive and challenging housing markets in the country. Only 21% of Bay Area households can afford the median price home. In elite enclaves like San Mateo County, the minimum income needed to qualify for a median home exceeds $500,000 for a $2 million property. Southern California presents a complex picture. The region, encompassing Los Angeles, Orange County, and San Diego, has shown remarkable resilience in maintaining high prices. Median prices in Los Angeles County reached $937,000 by the end of 2024. However, the Inland Empire offers more accessible options, with Riverside County posting a median price of $628,000. Some areas have seen recent volatility. San Francisco's median list price decreased dramatically from its $1.6 million peak in 2022 to $1.2 million as of January 2025, a drop of $400,000. Oakland experienced a similar trend, declining from $1 million in 2022 to $705,000 in January 2025. Yet even these corrections leave prices far above what most families can afford. Meanwhile, areas like San Jose show price acceleration, with prices up 11.2% year-over-year in January 2025. The market's behavior varies dramatically from city to city, creating a patchwork of local conditions that defy simple narratives. Double trap, mortgages, and property taxes. California homeowners face a unique double lock-in effect that's freezing the housing market unlike anywhere else in the nation. It's a phenomenon that explains why inventory remains stubbornly low and why many homeowners feel trapped in their current homes, unable to move even when they desperately want or need to. The first lock-in comes from mortgage rates. During the pandemic, the Federal Reserve dropped borrowing rates to near zero to stimulate the economy. Homeowners rushed to refinance, locking in historically low rates. Many secured mortgages at 3% or even below. Just over 77% of existing mortgages in California were below 4.2% in 2024. More than 80% of California homeowners have mortgage rates under 5%. Then came inflation, and the Federal Reserve reversed course dramatically. By October 2023, the prevailing mortgage rate on a 30-year fixed-rate mortgage had rocketed to 7.6%. Though rates have moderated slightly since, hovering in the mid-6% to low 7% range, they remain more than double what many existing homeowners are paying. The math is brutal. A typical California borrower would pay an extra $675 every month if they were to take on the same mortgage at current rates. In San Francisco, it's an extra $915 per month. For many homeowners, selling their current home and buying a new one, even if they're moving locally, would mean doubling their monthly mortgage payment. That's a compelling reason not to sell. But the mortgage rate lock-in is only half the story. California homeowners have an even more powerful reason to stay put. Proposition 13. Passed by California voters in 1978, Proposition 13 fundamentally changed how property taxes work in the state. It mandates a property tax rate of 1%, requires that properties be assessed at market value at the time of sale, and allows assessments to rise by no more than 2% per year until the next sale. What does this mean in practice? The longer you own a home in California, the less you pay in property taxes compared to a new buyer purchasing an identical home next door. In markets where home values have appreciated significantly, this creates massive disparities. A recent analysis by the Lincoln Institute of Land Policy found that new buyers can expect to pay more than twice as much in property taxes compared to a typical long-time homeowner in many of California's largest cities, including Los Angeles, San Diego, and Long Beach. The examples are striking. In Oakland, one homeowner who bought recently pays about $13,000 a year in property taxes on a home worth approximately $900,000. Just around the corner, a neighbor who's owned his similar duplex for decades pays only about $7,000. That's a 40% difference for properties of nearly identical value. When you combine both effects, mortgage rate lock-in and Proposition 13's property tax lock-in, the result is a housing market that's essentially frozen. From 1970 to 2000, the average tenure length of homeowners in California increased by 1.04 years relative to other states, directly attributable to Proposition 13. But the effect varies dramatically by location. Homeowners in inland California cities like Bakersfield receive Proposition 13 subsidies, averaging only $110 per year, and their average tenure length increased by just 0.11 years. But owners in coastal California cities receive Proposition 13 subsidies averaging in the thousands of dollars, and their average tenure increased by 2 to 3 years. By 2024, the impact had become even more pronounced. In Los Angeles, homeowners hold on to their houses for a median of 19.4 years, the longest span on record, and the longest tenure of any U.S. metro. San Jose followed closely at 18.3 years. Homeowners in San Francisco, San Diego, and Riverside also stay put much longer than the average American, who moves every 11.8 years. California is home to 3 of the 5 U.S. metros, with the biggest increases in homeowner tenure over the last decade. This isn't just about people loving their homes. It's about financial incentives that make moving economically irrational. The ripple effects. The lock-in effect has profound consequences for the entire housing market. When existing homeowners don't sell, inventory remains tight. First-time buyers and families looking to upgrade have fewer options. This limited supply keeps prices elevated, even when demand softens. Real estate agents who once specialized in helping families upsize or downsize now counsel clients to renovate instead. Many older homeowners are adding on and creating multi-generational homes, with their kids and grandkids moving onto the property. Others who do move hang on to their house and rent it out because low property taxes and low monthly payments make them view it as a financial asset. One Los Angeles Redfin agent explained the dynamic. Long-term homeowners tend to have low monthly payments. If they were to move, even using their equity as a down payment, they would have a much higher monthly payment because home prices and interest rates have soared over the last several years. The state has attempted to address this. Proposition 19, which went into effect in 2020, was designed to allow older homeowners to keep relatively low tax rates when they move. However, its impact has been limited, and the broader lock-in effects persist. Some economists argue that the lock-in effect makes California homeowners richer than they realize. By holding mortgages with below-market rates, they've essentially received a transfer of wealth from banks and bondholders. But that theoretical wealth doesn't help families who need to move for work, want to downsize in retirement, or simply need different housing as their circumstances change. The building slowdown. While demand challenges dominate headlines, California faces an equally severe crisis on the supply side. The state simply isn't building enough housing to meet its needs, and multiple factors are choking off new construction. In 2024, California's housing growth was among the slowest in the country. Despite being home to the nation's largest housing market, the state's pace of new construction lags far behind population and job growth. The typical Californian pays $2,280 a month for housing, 70% above the national average, a direct result of insufficient supply. California, with 11.7% of the U.S. population, accounted for just 6.8% of all new residential permits issued last year. That's a staggering shortfall. In a state where millions of new homes are needed to close the affordability gap, the pace of construction is hopelessly inadequate. Existing home sales and new construction have both struggled. In 2023, the number of homes sold in Southern California was the lowest in 16 years. While 2024 saw improvement, sales remained well below pre-2023 levels. The California Association of Realtors projects modest growth in 2025, but high housing prices due to low inventory and slowly decreasing interest rates continue to constrain the market. For new construction, areas like Los Angeles face particular challenges. The city is already densely developed, making new projects difficult and expensive. Land costs are astronomical. Community opposition is fierce. Environmental reviews are lengthy. The result is that very little new housing gets built where it's needed most, where growth is happening. New inventory focuses increasingly on areas with available land. The top two cities for new housing developments are Sacramento and Riverside/San Bernardino County. Developers are taking advantage of more open land and relatively lower costs in these areas. This shift has broader implications. People are moving to Sacramento and the Inland Empire not just for housing, but because job opportunities are expanding there. After years of post-pandemic population decline, California's population began growing again in 2024. Areas seeing growth and increased home sales include Oxnard, Sacramento, Riverside/San Bernardino, and Bakersfield. But this geographic shift doesn't solve the core problem. Moving housing production away from job centers creates longer commutes, increased traffic, and greater environmental impact. Workers who must drive 60 or 90 minutes each way to jobs in coastal cities lose quality of life and contribute to congestion and pollution. The regulatory tangle. Multiple factors constrain new construction, but regulatory barriers top the list. Home builders point to a tangle of burdensome permitting processes, environmental regulations, and local zoning laws that dramatically raise the cost, risk, and difficulty of building new homes. The California Environmental Quality Act, or SEQA, requires extensive environmental reviews for most development projects. While intended to protect the environment, SEQA has become a tool for project opponents to delay or kill housing developments through litigation. Even projects clearly needed for housing can be tied up in court for years. Local zoning laws add another layer of complexity. Many California cities have stringent zoning codes that limit the density of new developments and prioritize single-family homes over multifamily units. This not in my backyard or NIMBY mentality has hampered efforts to build affordable housing at scale. The California Legislative Analyst's Office estimates that the state faces a housing shortage of approximately 3 million units. Some analyses put the number even higher. Estimates vary widely, from as low as 56,000 units to as high as 3.5 million, depending on methodology. But regardless of the exact figure, there's universal agreement that California needs significantly more housing than it's currently producing. Policy responses. State leaders have passed numerous bills attempting to streamline housing production. Recent legislation has exempted certain infill housing projects from SEQA review for the first time. The state has also attempted to preempt local zoning restrictions that prevent higher density development. Governor Gavin Newsom has reorganized housing agencies, issued executive orders, and made housing a signature issue. Attorney General Rob Bonta has filed lawsuits against cities that fail to meet housing production targets. The legislature churns out housing bills each session, yet production lags. Every few years, Sacramento passes another streamlining bill hailed as the breakthrough that will finally unlock supply. The governor signs, advocates cheer. Cities issue press releases, and little actually changes. Senator Scott Wiener, a leading housing advocate, argues that California must say no to NIMBYs and the city councils that are yelling at them. He's right that local obstruction has been a major barrier. But there's another form of obstruction just as powerful: the state's unwillingness or inability to invest directly in housing production at scale. Most legislation presumes private developers will fill the gap once restrictions ease. That faith in market equilibrium has been belied by recent trends. Developers face high land costs, expensive materials, labor shortages, and tight credit conditions. Even when zoning permits higher density, the economics often don't work, especially for affordable housing. The affordable housing gap. The challenge is particularly acute for affordable housing. The California Housing Partnership estimates the state needs 1.3 million units affordable to people making under certain income thresholds. Market rate development, even when accelerated, doesn't address this need. Projects targeting the missing middle, those who earn too much to qualify for subsidized housing but too little to afford market rents, require years of planning and multiple layers of approval. Even successful projects represent drops in an ocean of need. Some experts argue that as long as affordability is treated as a side benefit rather than a central goal, the housing crisis will simply evolve into a different kind of crisis. Market-rate apartments will fill with those who can afford $3,000 rents. The working poor and lower middle class will remain priced out. California has spent $20 billion over the past 5 years dedicated to homelessness and housing programs. Yet the crisis persists and in many ways has worsened. This suggests that the problem requires not just more funding, but fundamentally different approaches to how housing gets produced and who can access it. The 2025 to 2026 forecast. Despite the challenges, housing market forecasters see cautious reasons for optimism. The California Association of Realtors released projections suggesting modest improvement ahead, though nothing resembling a boom. For 2025, existing single-family home sales are forecast to total 304,400 units, an increase of 10.5% from 2024's projected pace of 275,400. California's median home price is forecast to climb 4.6% to $909,400 in 2025, following a projected 6.8% increase to $869,500 in 2024 from $814,000 in 2023. These projections assume mortgage rates will moderate. As rates ease from their recent peaks, the lock-in effect should gradually diminish. Some homeowners waiting on the sidelines will decide the time is right to sell. Buyers who've been priced out will cautiously return as monthly payments become more manageable. Looking to 2026, the forecast shows continued modest improvement. Home sales are expected to reach 315,200 units, up 3.5% from 2025. The median home price is projected to increase another 2.6% to $933,000. Housing affordability is expected to improve slightly, reaching 18% in 2026, meaning 18% of households will be able to afford to buy a median-priced home. That's up from 16% in 2024 and 17% in 2025, a small but welcome improvement. Inventory is forecast to increase, with active listings potentially rising by nearly 10% in 2026. When more homes are available, it eases some of the intense competition in the market. This could give buyers more breathing room and potentially moderate bidding wars. Recent market indicators. The most recent data from September 2025 shows these trends beginning to materialize. Home prices in California were up 2% compared to last year, selling for a median price of $831,600. The number of homes sold was up 9.2% year over year, with 24,430 homes sold in September. Available inventory rose 10.8% year over year, reaching 114,286 homes for sale. The unsold inventory index was 3.6 months, meaning it would take 3.6 months to sell all available homes at the current pace. That improved from earlier in the year, but still indicate a market that favors sellers over buyers. Homes that sold above list price declined to 33.2%, down from 41.1% the previous year. Price reductions increased, with 26.9% of homes having price drops, up from 23% the year before. These metrics suggest buyers have slightly more negotiating power than during the frenzied pandemic years, though the market remains competitive. Days on market increased to 47 days, up 11 days year over year. This return to more normal timelines gives buyers time to conduct proper due diligence rather than rushing into decisions under 24-hour deadlines. Jordan Levine, the California Association of Realtors Senior Vice President and Chief Economist, summarized the situation. The housing market showed modest improvement in September, with both sales and prices up from a year ago. He cautioned that broader economic factors could influence the pace of recovery, but the underlying trend appears positive. Wild cards and uncertainties. Several factors could significantly alter these projections. Federal Reserve policy on interest rates remains crucial. If inflation proves more stubborn than expected and rates stay elevated longer, the housing market recovery will stall. Conversely, if rates drop faster than anticipated, demand could surge and push prices higher again. Migration patterns will be critical. For decades, California attracted people from around the world seeking opportunity and a better life. In recent years, that pattern has shifted, with more people leaving California for other states than arriving. High housing costs are a primary driver of this outmigration. Whether this trend reverses or accelerates will fundamentally shape California's housing future. If talented workers and families continue leaving for more affordable states, it could ease pressure on California's housing market, but damage the state's economic vitality. If the state successfully makes housing more affordable and accessible, it could reverse the exodus and reignite growth. Recent events add uncertainty. The Los Angeles wildfires have completely upended outlook for some areas. Property values plummeted in areas affected by the fires. Homes in Altadena and the Pacific Palisades even sold at drastically reduced prices. Insured losses reached at least $28 billion. Increasing weather risks, along with restrictive policies, are pushing major insurance carriers to withdraw from California. This creates additional barriers to homeownership. The long-term implications of climate change for California's housing market remain difficult to predict, but potentially severe. Economic conditions nationally will also play a role. If the broader U.S. economy enters recession, California's housing market will suffer. Job losses reduce housing demand. Stock market declines diminish down payment funds. Business closures reduce the need for worker housing. Conversely, if the economy remains strong, California could see continued modest improvement. Technology sector health is particularly important given California's concentration of tech jobs and tech wealth. A resurgence in tech hiring and company valuations would boost housing demand, especially in the Bay Area and other tech hubs. What it means for Californians. For prospective buyers, the current market presents challenges, but also the most breathing room seen in years. Rushing to buy out of fear of missing out is no longer necessary. Taking time to find the right home, negotiating on price and terms, and conducting thorough inspections are all possible again. However, affordability remains the overwhelming barrier. Unless household incomes rise dramatically or prices fall significantly, homeownership will remain out of reach for the majority of Californians. Waiting for perfect market conditions may mean waiting indefinitely. For current homeowners, the market remains favorable for those who need to sell. While the days of instant multiple offers above asking price are largely gone, properly priced homes in desirable areas still sell relatively quickly. The lock-in effects mean many homeowners will choose to stay put, but those with compelling reasons to move can still achieve successful sales. For renters, the outlook is mixed. As it becomes harder to buy, rental demand remains strong. However, rent growth has slowed significantly compared to its pandemic-era peaks. Some areas have even seen rents decline as new rental construction comes online and demand moderates. For policymakers, the crisis demands continued attention. Every streamlining bill, every lawsuit against obstructionist cities, every dollar spent on affordable housing programs helps at the margin, But transformative change requires confronting uncomfortable truths about California's approach to housing. The state must build significantly more housing, and not just in distant inland areas, but near job centers. It must make building housing easier and cheaper through genuine regulatory reform. It must invest directly in affordable housing production at a scale matching the need. And it must reconsider policies like Proposition 13 that, whatever their original intent, now contribute to market dysfunction and inequity. The path forward. California's housing crisis is not an act of nature or an unavoidable consequence of the state's prosperity. It is a direct result of policy choices made over decades. Restrictive zoning, burdensome environmental reviews, underinvestment in public housing, and property tax policies that discourage mobility have combined to create the current situation. The good news is that what has been created by policy can be fixed by policy. Other places have successfully addressed housing affordability through sustained, comprehensive approaches. California has the wealth, talent, and resources to do the same if there's political will. The question is whether that will exist. Housing reform inevitably creates winners and losers. Existing homeowners benefit from high prices and restricted supply. New regulations threaten established interests. Affordable housing projects face neighborhood opposition. Every reform has organized opponents and diffuse beneficiaries. Overcoming these barriers requires leadership willing to prioritize the future over the present, the needs of aspiring homeowners over preferences of current owners, and the common good over narrow interests. It requires voters willing to support leaders who make these tough choices. The stakes extend beyond housing. California's ability to attract and retain workers, maintain its economic dynamism, and provide opportunity to all residents depends on solving this crisis. Housing costs ripple through every aspect of life, from education to healthcare to environmental sustainability. The market won't solve this on its own. Waiting for prices to crash or supply to magically appear will mean continued suffering for millions of Californians. Only deliberate, sustained action by all levels of government, combined with support from voters and communities, can break the cycle. California's housing crisis stands at a crossroads. Modest improvements in sales and inventory suggest the worst freeze may be thawing, but fundamental affordability challenges persist, driven by insufficient supply, regulatory barriers, and market dynamics that trap homeowners in place while pricing out aspiring buyers. The state that once symbolized the American dream now exemplifies its breakdown. Teachers, nurses, and middle-class families can't afford homes in the communities they serve. Young professionals flee to other states. Essential workers face brutal commutes from distant suburbs. The gap between California's promise and reality has never been wider. Yet California has overcome daunting challenges before. With political will, policy reforms, and sustained commitment, the state can build its way back to affordability. The question is whether Californians are ready to make the difficult choices that transformation requires. The Golden State's future depends on the answer. For millions of residents and aspiring residents, the wait for that answer grows more desperate by the day. If you found this analysis helpful, make sure you're subscribed so you don't miss our future housing market updates. And drop a comment below. Do you think California's housing crisis will get better or worse over the next few years? We read every comment, and your perspective matters. Thanks for watching, and we'll see you in the next one.